Hello everyone and welcome back. My name is Greg Furman and this is the Forex Weekly Outlook for the week of April the 11th, 2016. Now, to get started this week, we're going to begin where we always do with the all-important US dollar index, a major player against the euro, the Swiss franc, the British pound, and even the Canadian dollar. Now, we can see here the forecast from VantagePoint on basically the March the 1st, VantagePoint was forecasting the dollar index moving lower. It's had some ups and downs throughout this. Now we're running along this lower trend line here. The key VantagePoint level, the predicted 18-day EMA 95.23 followed by 94.66 and 94.37 with a very bearish close of 94.25. Now, I don't think the dollar rally is completely over here by a long shot. We've had a lot of data over the last few weeks here with the ECB, the FOMC, all of these things causing the non-farm payroll number basically wreaking havoc on the markets, particularly when the central bankers speak. Now, our predicted short, medium, and long-term differences and our strength indicator from VantagePoint below the zero line, as is the predicted MACD. But the predicted RSI at 22.4 is starting to turn oversold. We can see that last time we were down at this level, we did have a bounce off this lower trend line and we started to move higher, only failing at the VantagePoint key 18-day predicted EMA, and then we've turned lower yet again. So in most particular cases, we look for repetitive patterns here. We can see that the dollar basically sold off at or about the beginning of the month here, and then it started to recover towards the middle of the month. Now this is an inverse move to what we normally see, so we're seeing that flight to safety usually around, money going out of the dollar around the middle of the month. Money is actually going into the dollar at the beginning of at the middle of the month. So things are changing in the market a little bit here, which I'll explain as we go forward. But for now, the key thing to identify here is we're looking for some kind of base on the dollar, and if we're going to see that, it's probably going to be towards Wednesday or Thursday of this coming week. Now, one of the driving factors that's also the intermarket correlation that's pushing that US dollar lower is, of course, the global equity markets, particularly the Nikkei and the DAX 30. We can see as the DAX 30 sells off, the dollar's reacting to this. And again, as we started to make a top on that DAX 30, the euro turned around and started to strengthen, and the US dollar again sold off across the board. Now, as we come into the S&P 500 next for this coming week, I talked about last week that I didn't really think that the S&P was going to produce any real gains last week, which of course it didn't. It pretty much has a top, more or less a top in place around this 2080 area. And again, as I stated, my rationale for that was that the global equity markets are not moving higher. The global equity markets are moving lower. So the fact that the S&P 500 is going higher is unusual. And what I suggested was that basically the S&P 500 is the odd man out, and that it would be very difficult for it to move higher, particularly with the Japanese yen strengthening, another strong intermarket correlation. Now, we can also see another driving factor that led to that, that assisted with that sell-off in the S&P and some of the equity markets last week, is the oil prices. The VantagePoint forecasting last week that oil was turning lower yet again. Now, we have got a base down here at about the 37 mark, but we can see a long bar up on Friday. Every time we see a bar like this on a Friday, it almost never follows through. So in thin illiquid trading on Friday, we can see a big move up on oil, closing the week at 40.99. We do have a lower high, absolutely, but we're not really having any higher highs here. So we could see a mild recovery in oil next week, but I don't think we're going to see a trend reversal at this particular time. So again, watch this 39.24 area. We've closed at 40.44, the key VantagePoint support level, which acts as a pivot area for potential longs, which would be 39.24. A break of 39.24 would see oil resume its downtrend, so watch very closely for that. Now, as we come into gold for next week, with that dollar weakness, the gold is getting a minor boost again, but we're very tight to this area here. We've closed at 1242. That's above all three of the key Vantage Point predicted moving averages: 1237, 1233, and 1234.27, the key level. Now, gold will have further upside provided we hold above 1234 next week, but my optimism on that remains heavily guarded at this particular time. Now, as we come into our Forex pairs for next week, based around what we're seeing here, what we've been dealing with in 2016, we can see that the euro is up against, again, up against a very significant resistance area. I've drawn this trend line in here. It comes in about 114.60. It's struggling here, guys. Now, much like last week when I talked about the dollar yen, and I'll talk about that again in a minute, what I said last week and what we actually did, the euro represents the potential for an equally as good of trade. Now, if the equity markets sell off, believe it or not, based on the intermarket correlations that I'm seeing, that would actually push the euro significantly higher. So if we can break through this trend line, the euro is going to run probably to the 117 area. But if it can't break through this area, then euro US is likely moving back down to this key Vantage Point level at 112.88. But again, watch for a confirmed break of this trend line, a close above this trend line. We'll see a very aggressive move to the upside. I'm not in the least convinced that that's going to be next week, just to clarify, but I'm pointing out this key level so you guys can trade off of it. The key Vantage Point indicators, I think, would to some degree agree with what I just said. Our neural index is pointing back down. Our predicted short-term difference and our short-term strength indicator breaking below the zero line. This is not indicative of a bullish move. I'm not saying that that's not going to happen, but I'm saying the shorter-term indicators from Vantage Point are telling me we're losing upside momentum and we're up against a very, very significant range top here. So we would need to see that range top break decisively, and by decisively I mean closing above the 115 area. Then we'll have a clean run up to 117. Okay, but again, my optimism, I'm not confident that that's going to happen based around these indicators from Vantage Point. Our RSI is getting overbought, our MACD is getting overbought, and again, the neural index is saying momentum moving lower. So watch those key levels that I've talked about and be prepared to trade off those. Okay, now with the US Swiss franc, the Swiss franc strengthening with those global weaker equity markets. We can see it's broken through this trend line here. The key Vantage Point level 96.49, 95.81, and 95.45 with a bearish close of 95.30. Now our short-term strength indicator and our short-term predicted difference, you can see much like the inverse to euro US, they're starting to move higher. Our medium term predicted difference is starting to turn back up also, and we are grossly oversold on the predicted RSI, which is suggesting that we could see dollar strength next week. So in order to see dollar strength next week, I want to see weaker gold. I want to see the S&P and the global equities turn around a bit. Even if it's just a corrective move, which I believe that's what it will be, that corrective move will boost the strength in the US dollar and demand for dollars. That's what we're looking for around the middle of the month, that we're going to actually have some demand for these US dollars. That's the key thing to watch for there. So our shorter term indicators are warning of that. I don't think that that's confirmed yet. We can see that the short term crossover from Vantage Point has not crossed to the upside yet, but when it does, we should have 2, 3, 4, 5 days of dollar strength. Now, as we come into the British pound for next week, you can see that I've redrawn in our trend lines here so everybody can see that. 140 is the breakout level here. If we can stay above 140, then the British pound has the chance to turn back around. Now, again, looking at those shorter term indicators, they are extremely mixed here. Our strength indicator is moving up, but our predicted MACD is breaking below the zero line. We've got good separation on the trigger, and our predicted RSI is below the 40 level. So when I look at this, we've got a very, very mixed signal. In my respectful opinion, the driving factor here for the next move up or down on the British pound is going to be geared towards oil prices, RBOB gasoline contracts, and of course the equity markets. So if oil and the equities both turn lower, then the British pound, guys, it's going lower. So, the key thing is to understand where we are in this cycle. 142.12 followed by 141.67. and 141.10. So we've closed below two of the three key VantagePoint predicted moving averages. Now our short-term crossover here for next week is starting to turn up a little bit off of this trend line, but that's not a crossover, guys, not in the least. So when I look at that, I look at the medium-term crossover, the long-term crossover, they are still saying that we're going lower. So how we play this is we look for a break of this trend line based around this crossover point and the additional indicators. The predicted MACD, it's saying that this pair is going lower. So again, if we break through the 140 level, get your shorts ready. This will go lower. Now, dollar yen, I'm going to take a moment to talk about what I said in last week's Forex Weekly Outlook. And basically, I gave everyone the green light to go ahead and sell a break of 110.60. Basically, what I said was that when we get below 110.60, which is basically the Vantage Point last week was already warning us here on this triple EMA cross that this channel was about to break. And when it broke, I suggested we should add to our shorts. And if you're not short already, sell a break of the 110.60. That came to fruition. We moved all the way down into the 107.50. That's the easiest 300 pips you're ever going to make, guys. And again, if you go and review last week's Forex Weekly Outlook, I basically called that before it even happened. The way I was able to call that is by looking at the global equity markets, the DAX, the Nikkei, the CAC 40, even the S&P 500. With all of these equity markets moving lower, money going into the Japanese yen, the US dollar didn't stand a chance against the yen based on that intermarket correlation. So when we look at this, we have all kinds of wild and wacky wave theories, Fibonacci levels, all this nonsense. The intermarket correlation trumped everything across the board. The bottom line is, and when it broke through this area, it just immediately moved to the downside. All of the indicators from VantagePoint here, guys, warned us days before that even happened. The neural index went down. The predicted short, medium, and long-term differences broke lower. Our predicted MACD crossed the trigger. Our predicted RSI breaking below the 40 line. Everything told us that this trade was going to happen 4 days before it actually happened. Okay, and if we break this down by crossover, we can see our short term down, our medium term down, and when the long term crossover went down, it just didn't look back. So from 112 down to 107, fantastic move here, guys. So remember, this does apply to what I've said to Euro US. If we break through the 114.80, 115 level on Euro US, it's going to run to the upside the exact same way. Okay, so that gives you some idea of what you should be looking for and understanding these intermarket correlations. So for the yen now, we are starting to flatten out. We are becoming grossly oversold, but trust me, guys, I've traded the yen for 10 years, and just because it's oversold does not mean it will not go lower. Okay, so I would look for opportunities to sell into rallies here, and the way we do that, we bring up our VantagePoint triple EMA cross, we apply that to the market here, we say okay, we drag our line over to our key thing, over to our last bar, always on our last bar, and we identify sell zones 111.23, 110.08, 108.73. So as we move towards 108.73 and 111.23, that's our sell zone. That's how we play this, guys. Excuse me. So for next week, again, we don't have any real indicators here telling us that this is going to reverse back to the upside. Any move back to the upside will likely be corrective in nature as the dollar yen starts to make its next leg down. Now, if I look at this pair over the last year, which is very interesting, you can see that we've actually been very slowly grinding lower here from the 126 level over the last 12 months. Any move higher has been we have not made a new high in basically the last 12 months here, guys. Okay, and that last new high was essentially 126. So when we look at the bigger, broader trend, it would suggest that we are going lower on this and we should be selling rallies. So we just simply follow the VantagePoint indicators and then just follow the money. Okay. Now, as we move into our commodity currencies, these are going to be very tricky. Now, again, like last week, I talked about this, a fantastic call from VantagePoint back here, not just on the short trade here, but if we look at this over the last 9 months, this was an absolutely terrific buy on the VantagePoint from this 123 level, 117, 118 level, or excuse me, about the 128, 129 level, all the way up to the 149 level. But in equally good call on the way down. Okay, so nothing goes straight up, nothing goes straight down. These moves have little or nothing to do with Fibonacci, Elliott wave, Gann theories, all of these things that are thrown at us to confuse our trading. Intermarket correlations, guys, that's what causes these moves. That's just a statistical fact. An intermarket correlation will trump any other indicator on the screen. So what intermarket correlation do we need for US Canada to regain its move back to the upside? We need falling equity markets. We need falling commodity prices. That's what we need. So we've had a bounce on Friday, and you can see that we have failed on this upper trend line. And at that upper trend line, we also have the VantagePoint key 18-day predicted EMA at 131.29. We can see we've come all the way up to a high of 131.56. We just poked right above that, sort of like a cow poking its nose out of a fence, only to be knocked right back in, and you can see down we go. Now, that was directly caused by the spike in oil. Okay, the minor recovery in the equity markets. Gold starting to move up a little bit. These all help the Canadian dollar. And of course, we had the Canadian unemployment report, which was deemed positive. It was a bigger number. Now, bear in mind with the Canadian unemployment report on Friday that we got, that was such a great number. I think they were forecasting 10K new jobs, came out at 60. This is very much like the US U3 number. It can be revised, guys. The labor rate participation rate was not that great. And the 65K jobs, when they revise it next month, it could be 10, it could be 12. So never hang your hat on economic news or an economic number, because it doesn't necessarily mean that it's accurate, okay? So we have to be very, very cautious with this pair. If oil turns around and moves down, the US CAD is going to move back up. So right now we're playing a range between basically this lower trend line down around 128, 128.50, and the upper trend line, which is consistent with the VantagePoint 18-day predicted EMA at 131.29. So if we can push back up above 131.29, 130.75, then the uptrend will resume. So in order for that to happen, we look for equities to move lower, we look for oil and commodities across the board to start falling again, and US CAD will move higher. The length of time that it's been moving down also suggests that we could be getting ready to turn around on this pair very, very soon. Okay? Now, speaking of commodities, currencies and commodity-driven currencies, we've got the Aussie and the New Zealand. Now, no new swing highs here, guys. The key thing, first thing I want to point out, 75.46, we've closed right on that number, 75.47, but you can see that we've got a new top in place up here at or about the 77.10 area. We would be shorting this as long as we're below that level. Now, as I zoom this in a little bit closer so everybody can see it a bit better, we can also see that VantagePoint, we've got a triple EMA cross here about 3 days ago, and we're pushing and trying to close below this trend line. Now, a break of this trend line, once again, guys, when we see a break of an area like this, and the VantagePoint indicators are warning us of this, right now we've got the predicted MACD crossing the trigger, the neural index is down, the predicted RSI pushing lower. As we look at our individual crossovers, our short term has given us basically a 4 to 5 day jump on this trade. Okay, our medium term crossover, you still got a 3-day jump. Our long term crossover, we're only 2 days old. This suggests that this trend line is not going to hold. Now, what would it take for this to break? What would it take for the VantagePoint indicators? An intermarket correlation here is the equity markets. If the equity markets turn higher, the Nikkei, the DAX, the S&P 500 on a corrective basis, that would push the Aussie US back up. So that's what you're looking for. But right now, it doesn't look good. And if the euro breaks out to the upside, that's another nail in the coffin for Aussie US, because that means that the global equity markets are selling off. If the global equity markets sell off, Aussie US crashes. So get ready here, guys, for a potential very good short trade. But if the equities turn around, the dollar will strengthen, but it will not strengthen against the Aussie. Okay, very important that I outline that. And to even take that one step further, when we look at our actual correlation and what a driving factor with the Aussie US currency is, we can bring up our intermarket correlations directly so we can see how it's forecasting with VantagePoint and what these intermarket correlations are, because that's a very important issue, because I constantly hear people saying that, based on Fibonacci, the Aussie's going to bounce higher, or, wave 2 of wave 6 or what have you. Again, when we look at this, the driving factor of why the Aussie US cannot make any gains despite a weaker dollar is because of the Nikkei. The Nikkei is pushing it lower. When we look at copper prices, you can see that as the copper prices move up, the Aussie dollar moves up. But as the copper prices weaken, all of a sudden the Aussie currency stalls, okay? The DAX 30, we can see almost 100% correlation to the European equity markets and the Aussie currency, okay? And this also applies to New Zealand, by the way. So these are all things that are tangible, things that we can see. Now, the S&P 500, again, as I had said last week, in most cases, the Aussie is up basically about 100, well, nothing's 100%, it's about 90% correlated to the S&P. So as the S&P 500 basically stalls, which is what I said last week would likely happen, the Aussie stalls. So if I draw a trend line here and a trend line here, the Aussie dollar, it's almost identical. So not a surprise with my own direct clients, we are selling Aussie US all of last week on any rally higher into those key vantage point levels. So it's understanding how these intermarket correlations work. And even with oil, you can see that Aussie does have a very strong correlation to oil also. So if oil turns back down, guys, and the S&P turns back down, the Aussie is going lower. That's just a simple fact. And that's not me necessarily saying that. That's the intermarket correlations that I'm pointing out here based around forecast from the VantagePoint software. These are things that we need to be cognitive of. And if we are, then we ignore all of these other, somewhat silly, ridiculous conventional indicators that tell us to, we should be doing this because it's overbought or it's oversold or, yada, yada, yada. We have all these complex theories of why we should be doing something. Basically, by splitting those screens, I'm showing you that if this goes up, this goes up. If this goes down, this is going to go down with it. It's a very simple concept, but it's a very highly accurate one. So when we look at the New Zealand US, the same thing here, guys. We've got a key resistance point now coming in at about the 70-cent mark. The exact same things are happening. And if we look at New Zealand last year at this particular time, it went into a massive downtrend from 78 until it started to pause here at the 62 level. Now, I'm not saying we're returning back to 62, but I'm saying the probability is higher than not, that we are moving lower. The VantagePoint Triple EMA cross trying to complete here. We can see we're absolutely struggling in this area. 67.88, 68.10, 67.99. We've closed at 67.95, so you can see we're basically sitting on a potential break here too. Our short-term crossover gives us the warning. Our medium term is also telling us we're going lower, but our long term is not convinced. So the New Zealand is slightly stronger. The New Zealand US slightly stronger than the Aussie US, but it's coming under pressure also. What will it take for it to break lower? The same thing with Aussie US. The same thing that I just showed you that drives Aussie US will ultimately drive New Zealand US. Okay, so it's very similar, almost identical trade. The New Zealand is showing a little bit more strength in that, than what the Aussie is, but again, there isn't enough of a difference between these two pairs to say, that I would buy one and sell the other. I would either sell both or I would buy both. That's what I would do. So I would be very, very cautious with these pairs. Once again, let the market settle in on Monday, Tuesday, Wednesday, Thursday. We see the real price of the market, and again, we're going to have a little bit of a choppy week next week, but we are going to see some trends start forming very soon.